What's up, everybody? Chris Dover here, founder of PollinAteTrading.com. Today, we're going to have a look at some interesting developments in the U.S. equities market, probably the whole world. But we'll start here. Like, subscribe, share this with your bestest friends. Please, I do this for free, and all I ask, you get the word out there for me. Thank you. Let me start sharing my screen. While I do that, do hit that like, do hit the subscribe. Okay. The whole world right now is on one about the S&P bottoming. Let's see if I can find one. Here we go. And okay. There is this trend line that everybody is focused on. Everybody is bringing up. Everybody is talking about getting rejected at or whatever. Whatever. Look, I personally don't have any, that has nothing to do with my trading. But everybody's talking about it. And, something else everybody's talking about, this little thing right here, this Fibonacci retracement from the December highs to the January lows. All sorts of things. Everybody is suddenly calling market bottoms. Everybody is calling market tops right here. And I don't have an opinion, but I do know, I'm going to show you what I look at and why I started to get long back in September, October timeframe. And I sent that email out. I posted that. That's on the site. You can see when I posted, I think it was September 12th or something like that. So definitely not bottom tick, and I'm not claiming I bottom ticked this market at all. But what I can say is I started getting long in that time frame, and in fact, my son's account, his Uniform Trust for Minors account, has been buying up the Vanguard. The Vanguard indexes since then, and doing okay. But let me show you what got me moving here. So the first thing I'll bring up is this is the S&P 500 futures all the way back to 1998, and this bottom area here, these little indicators at the bottom, is the commitment of traders. So the white line is the number of large traders who own S&P 500 futures. And the blue line, I assume that's blue, is the number of small traders who are holding S&P 500 futures. This is their commitment of traders. Historically, this dotted line you can see on there, that is historically low levels. Notice the small traders, the blue, and they're the most active, up and down, up and down, up and down, up and down, right? The larger traders are kind of, they'll stay for a long time in a bull market, right? From 2016 to 2018, they kind of stayed long mostly, whereas the small traders were back and forth, back and forth, back and forth, right? And you can also see oftentimes when a top comes in is when the small traders are at their highest. Conversely, when bottoms are formed is when the small traders have their least amount of exposure. And occasionally, both of them have their least amount of exposure. And if we look back at the global financial crisis, the small traders had their least amount of exposure, and then they started to get back in. And you can see we eventually, everybody kind of got below these levels down in 2010, again 2011, and in here 2011 is when the last time we ever saw the large traders ever get that low of exposure happened here, September 2010, flash crash. It happened here again in 2011 when the US debt downgrade happened. And since then, the next time it happened was 2022. Okay. So from our last example would have been fall of 2011. Each time we've had both trade commitment traders at that low, that historic level of low, market has been up since. Okay, so that's nice, good. Doesn't mean that, it doesn't mean we're going to go up, but it is showing that we are at historical lows there. Now, another indicator that I like to use is the 10-day advancing issues on the New York Stock Exchange. So it's a 10-day average of a simple moving average of the NYSE advancers. When that gets below this 1,000 level or so here, we typically get, you could see in January 2016, we had a bottom here, January 2016, right in that area. Eventually it took off. And, the next chance we had to drop back down was during vol apocalypse 2018. You can barely see this, by the way. This like S&P 1900 got all the way up to almost 3,000 from there. So like a 50% move, even though it doesn't look like anything there. Similar over here, 2018, bottom to the top. And then this would have been COVID bottom, and of course, rip to the top. So these things lined up for me this back in September. So when this guy broke, during the summer, I saw this and I was like, okay, I think we're getting there, but it wasn't really any catalyst. But in September, we finally got that ultimate spike on the NYSE advancing issues at the same time that small traders were at, near historic levels. Last time they were there would have been global financial crisis, flash crash timeframe. So 12, 13 years ago was the last time that they got that low. So we had a catalyst. This is when I said, okay, we are ready to start getting long. I think we're done. I think we're bottoming out. And from there, what I want to see is I want to see a move above here. I want to see it spike to extreme lows and then eventually get itself up above extreme highs. And we haven't been above that level. Last time we were above it was June 2020. Prior to that would have been January 2019, immediately after 2018 crash. So it's rare instances that we've gotten above them. But typically when the advancers move above after a spike low, you get a very long, prolonged, nice, easy bull market. And that's the case that looks like we have forming here. Now, the final thing, and I don't have the actual algo here at the moment, but when you have a monthly close on the S&P 500 of a daily 50-day moving average, so over the end of January, we would have to close above the 50-day moving average. If you go long from there, that's generally a pretty nice move forward. So we're pretty close to that happening right now. And I'm not saying that it's going to happen. I'm not 100% that any of this is going to happen, but we've had a lot of unprecedented breadth indicators and a whole lot of worry right now, a whole lot of worry. Now, I'm not saying, if we do end up in a bull market, that we're going to hit 10,000 like right away. I mean, we could just work our way up to the 5,000 level over the course of the next year. It could take plenty of time. It just means, in my mind, we're done with the major selling for now. Now, my buddy over at Quantified Edges sent this email out today. If you're not a subscriber, go to quantifiableedges.com. Get signed up for his free newsletter. Good stuff. Every week or so, he'll send out a nice email about the different quantified results. Like, every day that the S&P has had a 5-day down move, the following 5, 10, 20, 60 days have been X positive or something like that. He has a lot of good information like that. So there's a couple of really big breadth indicators out there. You've got Walter Demir's breakaway momentum, BAM signal. You got Wayne Whaley's advanced decline thrust from his paper, plane, trains, automobiles, the thrust, and the 70, which is Quantifiable Edges' own breadth indicator. Let's see. So the BAM and the Whaley, the first two, when they've been combined, I think it's those two. Yeah. When two combine, it has been almost perfect 1 to 12 months out. All breadth certainly seems to be positive. So in 1974, it happened, 1976, 82, 82, 2012, 2019, and 2020. So 21 days from Friday, it was either Thursday or Friday that fired off. The average has been about a 4% move. Yeah, so 21 days is a month, trading month. 42 days, 5%, 63 days, 3 months, 10%. Let's look at the 252. So a 25% up move is the average from that low. And look, 100% of the time, this has happened since that. It looks like a couple of instances where it didn't there. So that doesn't mean just because we have it doesn't mean that it's that we're done. But this is a pretty good spot to be thinking that we might not be going a whole lot lower, and maybe they're done wrecking this market. Maybe, maybe we head into recession. Maybe. But right now, what I'm looking at, the things I'm looking at, I'm still looking to be long. I'm not looking to sell out anything on the long side. Now, when it comes to the day trading, that it's completely different. That has nothing to do with what I do in the day trading. Has nothing to do with the stuff that I'm talking about on the prop trading business at all either. I could care less what the long term is doing in the trends and all that. I'm just here to scalp throughout the day and get in and out of the markets. So I don't have anything to look at for on the short term prop trading side. I wake up in the morning, I get in front of my screen, take the setups, and I go to work, and that's it. All right, guys, that's all I have today. We'll see. I'm not recommending that this is it again, but it's a pretty good spot. There's a lot of good data that would suggest that we're probably going to be seeing higher prices from here. If not a year from now, should be somewhere pretty high, or higher, I should say. Like and subscribe. Check us out, pollinatetrading.com/lab if you want to join us in the trading lab. And I'll see you all later.